If your Forex chart looks calm right now, that is exactly the problem, because the macro dashboard behind it is flashing yellow. Welcome back to Harry Trades. Today we are looking at the late 2026 recession signals, a realistic US stock market crash scenario, and the defensive Forex plays that actually make sense when the S&P starts to wobble. First, what is flashing yellow? The US yield curve has been twisting back and forth. Jobless claims are drifting higher, manufacturing surveys are stuck below 50, and credit card delinquencies among younger borrowers keep climbing. None of these alone is a crash signal. Stacked together, they tell us the soft landing narrative is fragile. For a practical trader, that means one thing: expect volatility regime changes, not smooth trends. Now the S&P 500 scenario. Imagine the index rolls over from its current highs and slides 10 to 15% over a few weeks. What usually happens next? The dollar index spikes first on a panic bid because everyone needs dollars to cover margin and short-term funding. That is when Euro US dollar and GBP US dollar often get crushed, even if European data is fine. Then, once the Fed signals real cuts or restarts liquidity tools, the dollar tends to top out and reverse. That second leg is where many traders get caught fighting the wrong direction. So, here is the defensive playbook. 1. Respect cash and position size. In a recession scare, leverage kills accounts faster than bad analysis. Cut your typical risk per trade in half until the regime is clear. 2. Lean on gold for trend trades. XAUUSD historically loves the combination of falling real yields and rising fear. Pullbacks to higher timeframe support with confirmation are where I prefer to look, rather than chasing vertical candles. 3. Treat the dollar as a two-stage trade. Long DXY or short risk pairs into the initial panic, then flip your bias once the Fed pivots and rate cut expectations harden. 4. Watch correlation, not just price. When the S&P and Euro US dollar start moving together intraday, you know risk sentiment is in charge, and that should override your technical setup if they conflict. 5. Journal the macro context on every trade. Tag each entry with what the dollar, gold, and stocks were doing. Over a few months, you will see exactly which environments your strategy actually wins in. None of this requires you to predict the recession. It only requires that you stop trading every pair the same way, regardless of the backdrop. If this helped sharpen your late 2026 plan, comment gold or DXY below to tell me which one you want me to break down next in detail.